Hey everyone, welcome back to the channel, which is all about income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And today's video is going to be about HYLD, the Hamilton US Enhanced Covered Call ETF, which is actually the biggest position in my portfolio personally. And I wanted to make a video because it's been getting a lot of attention lately, a lot of negative attention. And, looking at the comments on YouTube, on our Facebook group and things like that, it seems like people are a little bit worried about HYLD because of the recent share price decline, and also been getting a lot of questions about the sustainability of the distributions, right? Of the high monthly distributions, which is almost, now, well, today, HYLD, I'm filming this on the 9th of September, and it is up today like the overall stock market, but it is still hovering at about 13% yield. So are the dividends or monthly distributions rather sustainable? Very common question that I'm getting. So today I want to do a deep dive into HYLD, and we'll look at the share price decline. I'll comment on how I feel, what I think about the dividend sustainability. And also I'll explain why I'm personally going to be investing $15,000 into HYLD. And at the end, we'll have a quick chat with the main man at Hamilton ETFs, once again, Rob Wessel, to get his comments on HYLD. And we'll talk a little bit about it, about the share price decline, the dividend sustainability and everything. So let's get to it right away. All right, everyone. So the first thing I want you all to really make sure you do is, and it might seem a bit odd and funny, stop looking at HYLD. Okay, you guys need to remember that HYLD is simply a middleman that holds 7 ETFs, 7 high yield covered call ETFs. Here they are right here. These are the 7, this is what actually makes up HYLD. So instead of looking at HYLD, you better look at the holdings inside. It's much more efficient, and this is really what's going to explain what HYLD is doing, because HYLD is just a combination. Here are the percentages. It's just a combination of these 7 ETFs plus 25%, right? Don't forget that HYLD has 25% leverage. It has that 1.25x here, right here. So whatever these 7 funds do, so stop looking at what HYLD does, look at what these 7 ETFs are doing, and then you need to make sure to add or remember that it will be enhanced 25%. So if these 7 funds are on a downswing, HYLD will also be on a downswing plus 25%. If these 7 ETFs are on an upswing, HYLD will be on an upswing plus 25%. So that leverage causes it to have a little bit more of a decline when things are going down, but a little bit more of an increase when things are going up. So instead of looking at HYLD, we have to look at the 7 ETFs inside of it. So QYLD, RYLD, XYLD, these are the 3 covered call ETFs listed on the US market. That's what it says right here. Very, very high yield. 3 of my favorite funds on the US stock market in terms of covered calls, in terms of income. Then we have TXF, which is from CI. This is a technology specific covered call ETF. So it has all the best, biggest technology companies. You have HBF from Harvest, which has a lot of brands, the companies with powerful brands. So it's a nice mix. HHL healthcare providers, mostly in the US. And then you have a small position here, 9.4% in the Horizons gold producers. So this kind of offsets or gives a little hedge, because that's what gold producers do. So, you have to remember that this is really the US, just like the name says, US covered call ETF. So it's going to be very US heavy, very technology heavy. Right, you got to remember that the US market, very, very technology heavy, whereas the Canadian market is more financials, energy, and utilities heavy, right? So let's actually look at all 7 of these ETFs. I put the chart year to date here, everyone. So QYLD, so let's just look at the biggest positions are really the QYLD, TXF, RYLD, XYLD, right? Those make up the biggest position. So let's look at QYLD year to date, down 21.5%. RYLD year to date, down almost 17. XYLD about the same thing. TXF is definitely the one taking the most of a beating because it's all technology. So QYLD is a NASDAQ 100. XYLD is the S&P 500. These are very technology focused or technology heavy, especially the QYLD. But TXF is all technology. And like we saw, it makes a pretty big chunk, QYLD and TXF, of HYLD. So yeah, TXF 31% down year to date. HHL a little bit more defensive, only down 7.45% year to date. The brands, which has a lot of US companies, mostly it's like 99% US companies. It has some technology, but there's other stuff in there too, like financials and healthcare and consumer, down 17% year to date. And then you have the gold one, which is down 15% here, but it's actually pretty much down a little bit more because the Horizons just changed the name. Used to be called HEP, now they renamed GLCC. So the graph is just showing from the end of June here, but it's pretty much minus 20% or something like that year to date. So if we look at H yield year to date, it's down 20%. So this is really, I'm actually surprised that it's not down more than that, because it's supposed to be a combination of these plus 25%, everyone. So this is really, really honestly nothing to be worried about. So if you're trying to figure out why is H yield going down, look at what's going on with these 7 ETFs. That will give you the answer. And of course, everyone, you have to remember that the US market is in decline right now. It has been in the last couple of months. There's a lot of volatility. And what's not helping it is it's very tech focused, the US market overall. So this is, of course, what's causing the share price to go down. Of course, it's starting to bump up in the last couple of days here with the overall US market. So H yield will pretty much do what the overall US market does. The index that they actually compare it to or are trying to replicate, of course it will never be perfect, is the S&P 500. The S&P 500 is, the top 500 companies on the US by market cap, indexed, of course, and it's very tech heavy. So this is just going to do what the overall US market does, in my opinion, plus 25%. Don't forget there's that leverage. And also, don't be too obsessed with the price, because this is an income-oriented fund. You have to remember, always take into account the nice distributions here, very high distributions, which have been remained fairly consistent. So if you're really obsessed with stock prices, everyone, if you're looking at this, well, to 12.97, you actually need to add up all these dividends, which are about 87 cents or something like that, and add it to the price of H yield. That will give you the total return, because you're right now looking at just the chart, you're looking at the price return. You got to make sure to look at the total return, which includes the income, and I'll talk a little bit about it with Rob in a second. So that's my comments on the share price decline here. This is really, really not raising any flags at all. It's doing exactly what it's supposed to be doing. So stop looking at H yield. Look at the 7 ETFs inside. That's what H yield is. It's really a middleman, and I'm not worried at all about it. And this is why it's my biggest position. I feel that this ETF is pretty much a dream come true for income investors. You have everything you need here. Good diversification, high yield. You don't have the risk of a split share fund of missing dividends, because this is just an ETF. It's a very cool way to get the awesome 3 US covered call ETFs by Global X, QYLD, RYLD, XYLD, in a Canadian listed holding. It's doing extremely well. It passed 200 million. I have no doubt whatsoever that this will be an awesome ETF to hold long term. So I am not worried about the share price decline at all. And the second question I get all the time is the sustainability of the distributions, right? So H yield recently passed 13%. Now it's a little bit lower than 13% just because it went up in price in the last 2 days. Is the distribution sustainable? Once again, everyone, I will tell you the same thing. Stop looking at the H yield, and we need to look at the distributions of the 7 ETFs inside of H yield. So the distributions that come from H yield literally come from a combination or the amalgam of the distributions that come from these 7 ETFs plus 25%. That's thanks to that great leverage, modest leverage we have. So let's look at the distributions of the 7 ETFs together, guys, and you'll see that there's really nothing to worry about. There's QYLD here, a big position in H yield, and as you could see, maybe a slight decline recently, but they at 17 cents in May, June. Now it's picking up a little bit. So there's no danger here whatsoever. I see no danger here whatsoever. You could go back throughout all the years, and it's typically between 18, sometimes a bit lower, to 20, 22 cents. So QYLD, no danger. RYLD, same thing. It's usually in the 20, 21, 22, 23 cent range, the distribution. Yes, they've been a little bit, tiny bit lower than the beginning of the year, but I still don't see any issue whatsoever. Here's XYLD staying very, very strong, no issues whatsoever. TXF distributions, these ones are quarterly, and the latest one is actually going to be declared in a few weeks at near the third week of September. But as you could see, I see no danger, nothing really, no red flags that stand out to me. HHL has not changed their dividend or this monthly distribution since 2015. It's the epitome of consistency, so there's no problem here. HBF, same thing, no problem here, no distribution reductions, no misses. Actually, HBF recently raised it. And then you have the gold one, which, as you could see, for the entire year here, 2022, there is no problem. They're fairly consistent. Yes, they do vary, like HYLD, RYLD, XYLD, and TXF, but there's no problem. So, guys, I mean, I can't stress enough that I believe that HYLD is a really, really good investment. I believe that there is no danger whatsoever in terms of holding it long term. I think the distribution is well supported. I mean, look at the distributions of the 7 covered call ETFs inside. Don't forget that this is a covered call ETF style. The power of a covered call strategy is the consistency of the distributions, to keep the distributions relatively stable. That's the advantage and the power of covered calls, because these distributions, especially these guys here, comes all from the option premium. You can't consider HYLD like a regular dividend stock, right? A single dividend stock where the dividend could be in danger. This is something completely different. A lot of these distributions, or most of them, come from the covered call income, which is actually, the premiums are richer during volatility. So hopefully this made you feel better. Now let's talk to the man himself, Rob Wessel, to see his take on HYLD, the recent performance decline, and distribution sustainability as well. All right, everyone, I am joined once again by Rob Wessel, a returning champion from Hamilton ETFs. Once again, Rob, thanks so much for coming. And just before we start, I'd like to direct everyone to Hamilton ETFs disclaimer on Hamilton ETFs website, hamiltonetfs.com/legal. Make sure to check that out before. So, Rob, today I want to talk about HYLD, HYLD. So, we spoke about HDIV a couple of weeks ago on the 1 year performance. HYLD is not hit 1 year yet, so we can't really talk about performance that much. But in terms of the news, or it's making a bit of headlines because it is kind of on a downswing, although recently it has picked up a little bit, 2% since yesterday. So I've been getting a lot of questions on HYLD. I'm sure you have also. So let's talk a little bit on, HYLD's performance, or the best you could talk about, and give us some insight on, some of the questions and concerns you get. So the first one we could try to talk about is, since inception, it's been out for about 6 months. HYLD is lagging the SPY or the S&P 500 about 5.5%. In terms of total return wise, I actually looked at this last night. It's down about 20% in 6 months. So a lot of people are concerned about it. What would you say is how would you respond to those concerns, basically?
Yeah. So first of all, thank you for having us on, Adrian. It's always great to be on your channel. And again, to reiterate that people should go to our disclaimer, hamiltonetfs.com/legal. So in terms of the numbers that you've pointed out, so in terms of the difference in performance between HYLD and the SPY, there's really 4 variables that are that influence that difference. The first one is currency. So the Canadian dollar has weakened, so that accounts for about 300 basis points, almost exactly as of yesterday. Obviously, there's a little bit of margin or leverage in the strategy. So in a down market, that will amplify the downside, as we have talked about on this channel multiple times.
Right.
So if you believe the market will eventually go up over your holding period, then we would hope that modest margin or leverage of 25% would be your friend. The third one is, and you may recall in the previous calls that we've had, is we can't really match the sector mix of the S&P 500 exactly. So the expression we use on our website is that we want a sector mix that's quote unquote broadly similar to the S&P 500 in the case of HYLD and the TSX 60 in the case of HDIV. So sector mix differences were a variable as well. So sometimes this works in your favor, as it did early post-launch of HYLD, and sometimes it doesn't. Again, the fund is still quite young, so we would hope over time that these things average out. I'd also actually point out kind of an idiosyncratic event, which would be number 4, which is, this is kind of a quirky thing, and it would be relatively rare, is that the global X funds that are in the fund, they rebalance in and around mid-month, and they actually all rebalanced on the 15th of July, which was right before a spike in the market. So when the market rallied, 3 of the funds in HYLD didn't participate to the degree that they would have ordinarily. So those 4 factors largely account for this difference. We regularly point out that these funds are for long-term investors. At some point the Canadian dollar will do better. Hopefully the leverage will be your friend. Sector mix differences will work themselves out hopefully over time. And global X funds, as they rebalance from time to time, there'll be times when it works in your favor and times when it doesn't.
Oh, that's very interesting. I wasn't aware of that. The global X rebalancing factor, which was a factor, I guess. Well, that's good. Yeah. Thanks for that information. And we've discussed this many times on camera, off camera. This is an income oriented type of fund, and many newer investors, all they look at is the stock price.
Right.
And this is something I made a recent video about it. That's doesn't make sense if it's income oriented, because you also have to incorporate the distributions. And I like the way you worded it in your email. You're looking at the price return instead of the total return. So right. My question to you is, how can you try to explain this to newer investors? Because sometimes I have a hard time with it, and I'm sure you get the question all the time. What would you tell them that you should be really looking at?
Yeah,
just the price.
Well, you absolutely have to look at the total return. The distributions of HYLD are actually fundamental to the character of the fund. So if you just look at price return, you're excluding the very essence of the fund, which is distributions. For example, as of September 13th, in just a 6.5, 7 month period of time, HYLD will have paid out nearly $1 of distributions, 97 cents, give or take. So I would assume that people feel that that cash coming in should be included. So you absolutely can. The worst thing you can do, or at least not the worst thing you can do, but one thing you should not do is compare price return of HYLD versus SPY, because you're excluding, again, as of September 13th, when we pay our next distribution, almost $1. You absolutely have to look at total return. So that's what you referenced at the beginning when you talked about the difference in returns between HYLD and the S&P 500, or SPY, I should say. But for sure. And so, whatever information data source you're looking for, you should set it for total return, not price return.
Yeah, total return. There's many online sites and calculators where you could plug in the information. It'll give you the total return instead of the price return. But a very easy way, and we discussed this before, that what you could do if you're looking at the chart. Well, if you're looking at the chart from 1 point to 1 point, so 6 months chart, and you're just looking at the price, well, add up the 6 months of distributions as well and add that to the price. Right. So you got to add those 14 cents. It's almost $1 total. So that will, prop up the if you're just looking at the stock price. That's an easy way to do it as well. But, always look at the total return.
Right. And it's particularly unhelpful in this particular instance because the yield on the SPDR is just over 1%. So the yield of HYLD is 13. The yield of the SPY is 1.4, something like that. So over a 1 year period, you would be excluding 12.5%, which I assume everybody would feel would be a useful number to include and incorporate in their thought process.
Yeah, of course. I tell, what I usually say, if the fund is not giving a dividend or income whatsoever, then look at the price all you want, because that's all there is. But if the fund is giving any sort of income, you have to incorporate it in the performance of the fund. So thanks, Rob. I really appreciate that. And I'm sure you get this concern again all the time. I get it as well, especially when the fund yield starts going higher and higher and higher, is how sustainable are the distributions? So what can you comment on the sustainability of the distributions for HYLD?
Yeah, so we can definitely talk about that. So what are some of the variables that support distribution consistency and sustainability? So the first one would be diversification. So the more diversified something is, and the different sources or more varied sources of incremental underlying cash flows, presumably the more secure it would be. So HYLD and indeed HDIV, they have underlying portfolios of hundreds of stocks. They have 7 constituent ETFs. They have 7 option strategies. We didn't pick these constituents out of, lightly. All of these underlying constituent ETFs have a long history of distribution. So one can never say the distribution will decline. But from our perspective, to the extent the distribution did change, it would not be driven by us. It would be driven by one of the constituent ETFs. So if one of the constituents cut its distribution by a significant amount, well, then, that's something that we would have to talk about and address. Because as we've talked about in the past, Adrian, our distribution yield is basically roughly 1.25 times the average of these constituent ETFs. So we're just taking the cash flows that come to us, multiplying by 1.25. So even if one of those constituent ETFs cut its distribution, it's still only 1/7 of the underlying ETF. So now we picked, 7, pretty solid underlying. I can't say that they won't change, but they have a long history of distributions. And so to the extent anything happened to our distribution, it would be the effect of a cause, the cause being the distribution would have to be reduced in some meaningful way in one of the underlying.
Yeah, yeah, and this is what I show in the video earlier. I know you didn't see it yet, but HYLD's distribution is based on the other 7, right? So if the 7 inside are not there's no distribution cut or anything like that. You cannot. There's no reason to expect a distribution cut on HYLD side. It's
well, what I would also say is, just again making a general comment, is why has the market declined? Whether you look at the Canadian equity markets or the U.S. equity markets, it hasn't really declined because earnings per share estimates and therefore underlying cash flows have declined. Primarily, it's declined because of multiple compression. The market has decided that it would like to pay a lower multiple on a dollar of earnings than it did a year ago. And so what supports the distributions of all of these companies underlying all of these income ETFs, not just ours, all of them, it would be the underlying cash flows and earnings of the company. So if I think perhaps, when you think about, the durability of distributions, or maybe even more differently, the potential growth of distributions, if you were worried, I think you would be more worried in a market environment where the correction was being driven by slashing earnings estimates. The market saying you can't earn as much, or not that you aren't earning as much as we thought you were a year ago, and therefore how does that ripple through to dividend policy and distributions? But in this instance, look at the Canadian banks. The Canadian banks are probably the best investment on the Canadian equity markets. They're 20% off their highs. These are six of the best banks in the world, along with the Australian banks. They're 20% off their highs, but their earnings estimates have not fallen. 100% of the decline of the Canadian banks has come from lower PEs, not falling earnings estimates. This is one of the reasons why we love HCAL, our Enhanced Canadian Bank ETF, because to the extent the market rebounds, this is a very good time for that. But as an aside, if you were worried about, let's say, leaving aside the constituent ETFs, and you're saying, okay, well, what's the environment for my distribution sustainability for anything I own? I would say one source of comfort you might have, regardless of what your holding is that this correction thus far has been driven by multiple compression, not falling earnings estimates, and therefore not falling cash flows.
Right. I think it's more overall sentiment.
Yeah, the market's
driving prices lower. So the stock market prices are based on investor sentiment, not necessarily the technicals. So this is why I always tell people, you look at what you're actually investing in. There's solid blue chips in HDIV, in HYLD. If you actually break them down, look what's inside the 7 constituents. What do you see? Mostly all solid, very big, very boring blue chip stocks that they're okay. They're going to be okay. Like you mentioned, the Canadian banks, HYLD is very tech focused. So you know what I mean? There's a lot of Apple, Microsoft, Amazon. These companies, yes, maybe they're slightly going lower, but it doesn't mean they're in big trouble, and there's all kinds of trouble ahead. So I always say to people, look at what you're actually investing in, and don't forget that a lot of the income that's being generated by these distributions comes from covered call income, right? It's not necessarily dividend income, it's a combination. And the expression I like to use famously is that covered call income is an infinite source of income, and it's actually easier to generate premiums or higher premiums when there's volatility. So this inherently makes it a defensive strategy. So that's what I usually say and try to comfort people, but we're kind of saying the same thing here.
Yeah, and I should reiterate that that's not to say that the market's pricing in a higher probability of recession. That's not to say there won't be a recession. I'm just pointing out in the here and now, the market's a forward, a discounting mechanism. It looks forward, and right now it is pricing in a higher probability of sluggish growth, but it's also pricing in uncertainty. The market's paying lower for a dollar of earnings across the board. The Canadian banks are a great example, paying less for that because of the uncertainty. So to the extent that as the market plays out in the coming months and quarters, if it looks like central banks have gotten a handle on inflation, well, then you're likely to see a pretty significant rally. And then to the extent that happens, then we would hope that given that there's a little bit of margin onto HYLD and HDIV and HCAL,
we'll recover a bit harder.
Yeah, exactly. So I mean, that would be our hope. I mean, at the end of the day, you don't buy a product that has a modest amount of leverage if you think the market is going to be down in 10 years. So by definition, if you're a long-term investor and you think over time the market's going to go up, and that's what that's one of the reasons we always caution people, not caution people, but we remind people that these funds are for long-term investors.
Course, long term. I mean, I'm all about long-term investing. This is not trading or speculating, getting in and out. This is your whole quality for the long term, and everything in HYLD is pretty much high quality.
Yeah.
Which I try to tell people. A lot of people just focus so much on that price, but they're not looking at what's inside and what you're holding. And you holding something long term, you got to expect fluctuation. The stock market sentiment, it's always going to be that way. It's been that way for hundreds of years. So
and we can't track. It's not really possible for us to track the S&P 500 or TSX 60 exactly.
Right. It's not going to be perfect.
Right. We can't, because there's just not that much granularity in the underlying covered call ETF universe in order for us to match. So there's always going to be a little bit of a mismatch. And so, as I said, in HYLD, in the early months, it was ahead of the S&P 500. In more recent months, it's fallen behind. But again, this is a very short period of time and not one that can be assessed reasonably. You have to go over the long term. Recall, the fund, we have a selective covered call index that you can look at that'll give you a history of what these 7 ETFs have done over a 3-year period.
Yes,
1.25 times that is basically in line with the S&P 500. But we can't we can't say, and would never say, that we are always going to outperform the S&P 500. What we're trying to say is we want a sector mix that's broadly similar. We want it to be as close as we can make an income version of the S&P 500, and for HDIV, an income version of the TSX 60. We're just trying to sort of synthetically create that through the weightings of these particular constituents. But we can't match it exactly, therefore the performance will not be exact. Now we're very lucky that HDIV has done so well relative to the XIU. The HYLD, which is highly complementary and we believe should be held with HDIV, they're highly complementary funds, especially because the two markets really have a great sector mix in aggregate. That one has worked out very well. Would not surprise me in any given period if it lagged. It's just because it's different. In HYLD, it needs a longer period of time and over a year or something like that in order to get a real full sense of how the mix is doing relative to the S&P 500.
Yeah, for sure. I mean, you got to look at the sectors as well. I mean, HYLD is more US focused, which means automatically it's going to be a lot more tech focused. And we all know what happens when there's inflation, that the tech stocks or the growth type stocks suffer more. Whereas HDIV is staying relatively strong because you got the 6 banks in there. You got the energy. It's a little bit more Canadian sector focused. But I tell people all the time that this could inverse anytime. I mean, if you look at 2020, it's the inverse, right? The financials were having a hard time. Energy was having a very hard time. Yes. Technology was flourishing because everyone was home and using all the companies that using the services that the technology companies offer. So this is, like you said, great complement, right, to each other. Those two ETFs, Canadian side, US side.
We think so.
Yeah. So, we talked a little bit about this with HDIV. So you recently did that shareholder vote where now you have a little bit more flexibility. So I have 2 questions about, and I think we already covered it in HDIV. So first of all, I remember on, it's still in the HYLD fact sheet. It says there's, HYLD will rebalance semi-annually. So first of all, are you still doing that? Are you planning on doing it? And what exactly does that mean?
Yeah, so we are not going to rebalance. What we are going to do, as you pointed out, we did the unit holder vote so that we could have more flexibility. So we will make changes to HDIV and HYLD over time. We are doing a continuous review. When and if we do make, or when we make changes, it will be the variables that we laid out in the unit holder vote. We will care about the relative return. We'll care about the cost of the fund. We'll care about the volatility and all the things that you would want us to look into. But our objective in this case won't really be to match the selective index. Instead, we are much more likely to try to refine the mix to get a little bit closer, in the case of HDIV, to the TSX 60, and in the case of HYLD to the S&P 500. Again, we can't do that exact because the universe of covered call ETFs is just not refined enough to get it exact, but we can certainly get a little bit closer. So when we make changes, those will be some of the variables that we take into account. We are, have a process internally where we're evaluating what, if any, changes to make and when, but it is a continuous process. We're not, one of the things that we talked about in a previous videos, as you recall, Adrian, is we didn't want, to do this unit holder vote and then remake a fund people just bought. We wanted to give it time. We wanted to, things were going well. We wanted to let things progress, see how they're doing, and at that same time, start that continuous review. And that review has gone on for a little while, and so we'll look at how we can refine these 2 products without while still honoring the initial mix that people, had bought, keeping what they like about it, and with the hope of just, making sure that the fund gets better.
Yeah, yeah, I'm excited about that because I like
Yeah,
the fact that you guys could add more stuff because I tell people or have a feeling that income-oriented investing cover call strategies starting to get more and more popular,
that's right.
especially now, especially with retirees who want income and stuff like that. And there's more and more of these funds coming out on the Canadian side. There's 5, 6 providers, and they're always coming out with new ones.
Yeah,
But even on the US side, it is a bit smaller.
right.
But you have, these great funds, cover call oriented funds like from JP Morgan. There's JEPI. They just came out with JEPQ, a NASDAQ version. So I find that hopefully there's more and more of these. And I like the fact that you guys are going to be able to incorporate
Right.
them and study them and add some new funds as you see fit. So I think that's a great idea.
And we don't have to be equal weight. We can be more than 7, or we're not going to be less than 7. We can be more than 7, and exactly as we've talked about in the past is there's all sorts of new products coming out. We want the ability to take advantage of that. So all we can say on rebalancing and or any changes is stay tuned.
Yeah. Yeah. I like the fact that you don't have to be equal weight because,
Yeah.
Personally, I starting to favor certain sectors more than others. Just for example, there's the gold producer one in HYLD, I believe it's a lower one. So I kind of like that you don't have to be equal weight. If you were doing the same rules as last time, well, you have to be equal weight. So more flexibility is better in my opinion, which is great.
Yeah, and to the extent we make changes, one of the big variables that'll be looming over everything is, can we get closer to the mix of these two great indexes?
Yeah, of course. These are the king,
The indices,
the king of the region, right? The S&P
right,
500 is always the king of the US. Everything gets compared to that,
right.
TSX 60 or the composite on the Canadian side. So thanks a lot, Rob. I appreciate your answers. Just one final question, just more on the environment of the ETF landscape in Canada. There's HYLD launched in February, but there's several new income-oriented ETFs that keep coming out, including HUTS, one that you guys are recently
Huts.
launched, the utilities enhanced, which is kind of like it's like what HCAL does, but with the utilities where you want the great utilities
Yeah,
stocks, but a little bit more extra total return, a little bit more extra yield with that 25% leverage.
right.
So, in your opinion, all these ETFs and new funds that are coming out, does that mean that the stock market sentiment is essentially still positive for the long term? What do you think this means? All these products coming out. What would be your comment
Yeah,
on
I
that?
mean, I think that's a great question. There's a couple things I would say. First is, I mean, every manager wants to launch on a correction. They want the starting date to be as favorable as they can.
Right,
So
to
I do
start
think there's
lower, right?
absolutely. So I do think I absolutely think that, the pace of launches and the spurt of launches, I do think that is implicitly can be interpreted as those managers feel that this is a good time, and therefore, one could reasonably infer that there's some bullishness behind all of that. Having said that, the ETF sector has just got lots of launches, so it's hard to say. I mean, because launches are just, it's arguably a saturated market, but there's so many products. But yeah, I think you can look around and say, that people are. We certainly launched, HUTS, or the Hamilton Enhanced Utilities ETF. We think this is a good time for that, and unfortunately we couldn't do it a little bit earlier. But had we, it would have been great. But for sure, I mean, no, it doesn't make sense to launch a fund if you think the entire sector is overvalued.
Right. Right. Yeah, that makes sense. I like it. I like more and more products. That just means
Yeah,
more
absolutely.
choice, more competition between the fund managers. They're always trying to, I feel competition keeps prices lower. It keeps people always trying to figure out more innovative ways, innovative ETFs. I mean, I always give you guys props all the time. HDIV, the first one of its kind, all-in-one cover call with 25% leverage, right? So, once again, Rob, thanks again. That's all the questions I had. I don't know if you want to add anything, but that's all I had
No,
for today.
no. What I would say is, first of all, we always appreciate your audience. We very much appreciate the confidence that your followers have placed in us. Not something we take lightly. We want to do well for you and for your audience, and so, we really appreciate it, and we do think these are excellent products and for long-term investors, and we look forward to chatting with you again in the future.
For sure. I know you'll be back. We'll do maybe a 1 year HYLD
Sure.
anniversary, but I'm sure we'll talk before then. Once again, thanks again for coming on. And just in case the audience doesn't know, you guys actually have a pretty nice newsletter that comes out. Is it monthly? Or my wife actually advised me that they actually have a nice newsletter that tries to it talks a lot about the banks, because you guys are obviously you come from the financial
Yeah.
sector. Is that a monthly newsletter
It's
or?
not it's not monthly, it's more event driven, but we
Okay.
do have a very robust commentary section on our website. We've been writing about global financial sector for over 10 years. I've been writing about the financials for well over 20 years. And all we're trying to do is give people some insight into the sector and write about things that are topical. For example, we wrote about TD buying First Horizon. We do try to write about the Canadian bank quarters just to give people an update on what's happening with the sector, because we're the #2 provider of Canadian bank ETFs. We have nearly $1 billion of Canadian bank ETF AUM under management. That's a lot of followers on the Canadian bank side. So we like to do what we can to help them understand what's going on.
Yeah, always appreciated. And because the Canadian stock, if you're a Canadian investor, you're going to be pretty heavy in the banks, right? Those are typically, it's always been the best 6 companies, on the TSX. So we appreciate that. So if ever you guys are interested, for the audience watching, you could sign up, put your email, and you could sign up for it. So yeah, we're signed up. So strongly suggest for you guys to do the same. So Rob, once again, thanks so much for your time, and talk to you soon.
Yes, thank you.
Thank you so much for watching, everyone. I really appreciate it. Don't forget to hit that thumbs up button, that like button, and make sure you're subscribed not to miss out on my future content. Of course, hit that little bell next to the subscribe button so you're notified for any new content that comes out. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once, which is awesome. So this is a companion tool. It's a reference tool that will help you build your own portfolio according to your needs and goals, and it covers both the Canadian and American and US stock markets. So make sure to check it out. I have a video explaining from A to Z exactly what the product is. I showcase it, so there's no surprises. If you're interested, make sure to check out that video. Also, right there on my website on the homepage, I do offer a one-on-one coaching session with me. So this is a 1-hour Zoom call with yours truly for in case you need personalized help. I'll answer all your questions and I'll help you best I can. Just remember, I'm not a licensed financial planner or financial advisor. These are just going to be friendly conversation, right? It's just going to be my opinions. But if ever you're looking for that personalized touch, that personalized help, you could book a one-on-one with me. Make sure to check out the message on top of that calendar. That will give you a status of my bookings for that month. Also, we do have a Facebook group, great Facebook group, over 12,000 members. So make sure to join our community. The group is called Passive Income Investing, a nice Facebook group where everyone is sharing their thoughts and opinions and sharing their experiences. So it's a really nice group. We make sure to stay on top of the scam and the spams, and we delete those right away. So make sure to join our Facebook group. If ever you want something more personalized with us, you could follow us on Instagram. That's where we post more personal things on our adventures here in Panama. So follow us on Instagram if you want. And how do I always leave you? Continue to stay safe, continue to stay healthy, and of course, stay passive. See you next time.